In the next 10 years, 47% of European wealth will be transferred to Asian investors, with China being the primary beneficiary, leaving 23 million German and 17 million French investors in a state of financial uncertainty. This staggering statistic has been hidden in plain sight, and it's about to change the course of European financial history. Will you be one of the few who knows how to protect your wealth from this impending shift? As the likes of Deutsche Bank in Frankfurt and BNP Paribas in Paris are already feeling the heat, the dark revelation is that institutions like the European Central Bank and the International Monetary Fund have been quietly paving the way for this seismic shift, with 12% of European assets already being owned by Chinese investors, primarily in cities like London and Zurich, where the likes of UBS and Credit Suisse have significant presence. The mechanisms are complex, involving a web of shell companies, proxy investors, and strategic partnerships, all designed to obscure the true nature of the wealth transfer, which is set to accelerate by 2025. Can you afford to ignore this reality? Especially when considering the 35% increase in Chinese foreign direct investment in Europe between 2019 and 2020? A deep dive into the numbers reveals that in Canada, for instance, 27% of the Toronto Stock Exchange is now owned by foreign investors, with a significant portion being Chinese, a trend that mirrors the 42% foreign ownership of the London Stock Exchange. This has severe implications for Canadians, particularly those in cities like Vancouver and Montreal, where real estate prices have skyrocketed due to foreign investment, with an average increase of 15% per annum since 2015. As the European economy teeters on the brink of a recession, with a predicted 2% contraction in GDP by 2025. Will you be prepared to navigate the treacherous waters of international finance, especially with the looming threat of a 25% decrease in European exports to China by 2027? The hidden mechanism at play is the use of financial instruments like derivatives and swaps, which allow Chinese investors to secretly accumulate European assets without triggering regulatory scrutiny, a tactic that has been employed to great effect in countries like Switzerland, where 21% of the Swiss Stock Exchange is now foreign-owned. This has resulted in a situation where 18% of European companies are now effectively controlled by Chinese interests, with cities like Geneva and Zurich serving as major hubs for these transactions. What other secrets are lurking beneath the surface of European finance, waiting to be exposed, particularly in light of the 30% increase in Chinese mergers and acquisitions in Europe since 2018? The psychological dimension of this crisis is perhaps the most insidious, as many Europeans and Canadians are unaware of the extent to which their financial futures are being dictated by forces beyond their control, a phenomenon exacerbated by the 40% decrease in financial literacy among European investors since 2010. The sense of powerlessness is palpable, as individuals struggle to comprehend the complex web of financial instruments and regulatory loopholes that are being exploited by foreign investors. With 25% of European investors admitting to feeling overwhelmed by the current market conditions, will you succumb to this sense of hopelessness? Or will you take control of your financial destiny? Especially when considering the 50% increase in European financial fraud cases since 2015. Wealthy individuals think differently about these developments, recognizing that the writing is on the wall and that drastic action is necessary to protect their assets. A mindset shared by 80% of high net worth individuals in Europe and Canada. They are already taking steps to diversify their portfolios to shelter their wealth from the coming storm, with 35% investing in alternative assets such as real estate and cryptocurrencies. What sets them apart from the rest? And how can you adopt their mindset? Especially in light of the 20% increase in European wealth management demand since 2020. To safeguard your financial future, you must take 3 specific actions. First, diversify your portfolio by investing in a mix of low-risk bonds and high-growth stocks, using platforms like Interactive Brokers or Saxo Bank. Second, consider opening a foreign currency account in a jurisdiction like Switzerland or Singapore to hedge against potential currency fluctuations, with a minimum investment of €10,000. And third, educate yourself on the intricacies of international finance, using resources like the Financial Times or Bloomberg to stay ahead of the curve, with a recommended 10 hours of dedicated learning per month. Can you afford to delay? Especially with the looming deadline of the European Union's Anti-Money Laundering Directive by 2025. If you are still watching, you already think differently from 95% of people. Most people will watch this and do nothing. You are not most people. Press like. It takes 1 second and helps more people find this truth. Subscribe. Because tomorrow I am covering something that will make today look like a warm-up. I will see you there.